What's up, investing legends? Today we welcome Patrick Grimes to the program. Patrick is the founder of PassiveInvestingMastery.com and has devoted his career to educating the masses, educating W-2 employees on alternative investing strategies to the stock market. After making several critical investing mistakes in 08-09, Patrick came out of the recession and was able to bounce back and create a robust investment portfolio that eventually allowed him to transition out of his full-time engineering career. And in this episode, we dive deep into the lessons learned and strategies deployed by Patrick, transition from full-time W-2 engineer to full-time investor. We kicked off the episode with Patrick detailing the concept of non-correlated investments that share differing market fundamentals. This is the foundation for his current investing approach and why he believes this is the smart approach to investing in 2025. Later on in the episode, we go over the alternative investing strategies that Patrick adopted coming out of the last recession and why so many Americans have been slow to adopt these alternative investing strategies that have made so many Americans incredibly wealthy. And finally, we conclude the episode with Patrick going over some of the recession-resilient investments that he's currently making, including litigation finance, which funds attorneys' contingency cases for a share of the profits. It's a very interesting, very niche investment strategy that Patrick shares a lot about. Super interesting stuff there. Patrick isn't the kind of guy that made a couple of lucky investments early on in his career and made tons of money, rode off into the sunset. This is a guy that has learned via his mistakes. He's made a ton of mistakes and he's vulnerable enough to share those mistakes with you so that you don't make the same mistakes. And he's generous enough to not only share the lessons that he's learned, but also share some of the investment strategies that he's currently using to win big in 2025 and beyond. So owe it to yourself to listen to this one, whether you're brand new to the game or you've been doing this for some time. I think there are little nuggets and little lessons in here for everyone. So without further ado, everyone, let's welcome to the show, Patrick Grimes.
Welcome to the Investing Secrets Podcast.
Patrick, welcome to the Investing Secrets Podcast, my friend.
Yeah, glad to be here. Excited about the conversation.
Me too. Are you ready to step inside the vault with me?
Let's do it.
Let's do it, man. All right. So you have quite an array of investment experience, Patrick. You know, had an opportunity to kind of like learn what you're in real estate. You've got litigation finance. You know, there's a whole hodgepodge of things that your debt funds, right? So I know that you're invested in a lot of different things. Where did this all kind of stem from? Kind of like walk me through how you got to this point.
Windy road, ups and downs. I started out as an automation and robotics engineer, probably like many of your listeners, high paid professional looking for where to invest. And everybody knows, like, here's your 50 stocks, startups, Bitcoin, whatever, but nobody knows about the 50 alternatives. And I was one of them. And during that time, I took some advice from one of the founders of the machine design firm I was working for. And he said, go dump it in real estate. So, I mean, I did, and I lost it all because that was back before 2009 and 10. And since then, I've been working hard at coming up with ways to build more resilience in my portfolio through, as you kind of mentioned, lots of different kind of lesser known or novel, what we call non-correlated investments.
Yeah. Well, let's talk about non-correlated for a second. Define that for the audience.
Mm-hmm. Well, so people are there say, I'm diversified in my stock portfolio. It all is driven by similar market fundamentals, right? Sentiment driven, the feeling of the worth of those stocks, right? The paper stocks. Same thing with real estate. Real estate in a large ways governed by cap rates, right? What things trade at, interest rates, right? Demand, right. Things affect overall housing markets. The housing markets and being diversified within real estate. If that's all you're in, that's not really diversification because you're going to ride one ride. And if there's a collapse, you'll lose everything like I did in 2009. But non-correlation means you're in investments that don't have the same market fundamentals. So the stock market and real estate don't ride the same wave. Sometimes they're down at the same time, but that doesn't mean they're riding the same waves. Oil and gas is a commodity that's non-correlated, right? But things that are correlated are like the gold and the US dollar. We'll call that inversely correlated. Gold's up, the US dollar's down, and then US dollar's up, gold's down. Things like, there are other kinds of industries which we call non-correlated because they're just needed in downturns. like the health industry, education, or our favorite is the legal industry. Everybody needs a doctor, good times and bad. They need skilling and upskilling in good times and bad. And attorneys do really well when times are good. And when times are bad and people get litigious, attorneys do really well. So it turns out to be that there is something out there of things that rise and fall together, things that rise independently, and things that just simply don't care what else is going on. And those recession-resilient, non-correlated type investments, that overlapping Venn diagram, that's the sweet spot.
So which investment categories or which asset classes or sectors would you loop into that like middle ground there?
So we talked about healthcare just now, education, legal industry, also things like plumbers and HVAC, CPA firms. All of those kinds of firms are things that just are needed, regardless of and then they're in demand, regardless of what market fluctuations and broader market cycles are doing.
Interesting. So when I think non-correlated, I think the playbook of the 1900s said invest 60% in stocks and 40% in bonds. So the bond market is supposed to be is supposed to help balance out the portfolio. What would you say to somebody that's using that in 2025?
Well, unfortunately, there's a lot of archaic ways of the past, mostly geared around the government trying to get people back into the stock market post the Great Depression, and the built out these ERISA type laws that took retirement accounts and forced them only into public equities. And Trump is actually in the process right now trying to undo some of that because that stocks and bonds simply doesn't work. It ensures destruction of your portfolio through inflation, and it ensures that those have not provided a non-correlated risk-adjusted return. And so it's important that people look beyond kind of the ways of, our dads and grandfathers to the 401k being it, and maybe an IRA account being it, and trying to figure out ways to get out of just that sentiment-driven stock market, especially today. I mean, you're talking about what would I tell a guy today? Well, Danny, we just got done with a Fed rate hike. 11 out of the last 14 of those ended in a bust. I'm not a doomsday guy, but that could be enough to cause a market major swing. But it's not it. We're also in trade wars. Trade wars with our biggest allies in the world's biggest economies. All we needed was that to cause. But that's not it. We're actually in 2 proxy wars, and we just bombed Iran. And that's not it. Any one of those or any combination of those could have caused issues. But we're also in a situation where the world's largest economies, the BRICS nations, are betting against the dollar while our debt's spiraling out of control. Now this big, beautiful bill is going to add $5 trillion, right? So we're going to be propped up for a bit here on that. But what's going to happen on the other side of it, and derating of the dollar, the inflating, it always makes sense to invest and allocate into non-correlated and recession resilience and to fortify your wealth. Especially so today. That's what I would tell somebody today.
It's interesting. I mean, I love that we're talking about this because it's become very apparent to me that the vast majority of individuals out there that have a significant amount of money to invest into these types of alternative assets still don't truly understand the concepts that you just discussed right now. Like, they do not understand the idea that the stock market and Wall Street is actually the biggest, like one of the biggest marketing scams of all time. All right. They still don't understand that. They're programmed. Everyone here is like brainwashed in the US to think like, hey, I make $1 and I should be investing it into the stock market.
We could talk about that all day.
Yeah, I know. I'm like, how much time do we want to spend there? Well, let me ask you this, right, Patrick? Like, of the investors that you work with, and we'll get into your business model in a second here, because I have a feeling I know what your business model is, but I'm genuinely, I think that people should understand what you're up to. But of the investors that you work with, How many of them come to you that are 95 to 100% invested in stock markets before you start working with them?
Come to me. Well, about half, 3/4 of our investors are repeat at this point. But I mean, you're saying of the
the ones that come to you fresh that aren't repeat.
Fresh.
Yeah.
I would say probably maybe 2/3 of them are heavily indexed at equities, and maybe they think they're diversified through. I had somebody this morning tell me he was diversified in the legal industry because he bought Burford stock, which is a stock. And then I write these articles about the ruse of REITs, and I've got them in Forbes and on my Wealth Accelerator, where financial planners convince people that they're diversified because they're in a REIT and real estate, and that
oh my
I show
God.
that directly correlated on my webinars. They're directly correlated to this. There's no value in REITs in my mind. So there's a lot of people that think they're diversified. They don't understand what that means when you talk about non-correlation. And then typically people are like, yeah, I'm a real estate investor. They got a rental, right?
Yeah.
But if you exclude the, hey, I've got a vacation home, or I've got a couple, maybe a rental or 2 rentals. If you exclude that, then probably about 2/3 of those individuals are thinking that they're diversified in these 2 markets, but they're typically not.
Yeah. My favorite is when somebody tells me that they're invested in real estate, and when I pry a little bit further, they own maybe $100 worth of shares in a REIT, and I'm like, that's not real estate investing. It's it's pretty comical. Where do I want to take this? I want to ask you about your business model here for a second. So how do you work, Patrick? How does your group basically help investors?
Well, we really have 2 sides of our business today. One is passive investing mastery, where we educate, and kind of my blue ocean approach. Back when I was an engineer, I wish somebody had showed me, hey, here's all the ways you can invest in alternatives. Nobody was doing that. I was working with some of the smartest people in the country. Facebook, Google, Raytheon, Boeing, Abbott, Johnson & Johnson on solar cells and EV vehicles and medical devices. And these guys were awesome, super sharp, doing automation robotics, but nobody knew about all these alternatives. And so we built a platform around introducing those, and it's the Passive Investing Mastery, Alternative Investing Mastery series. And we every week or 2, we bring on panelists to dig into completely different kinds of alternative strategies. So we just basically show the whole deck of cards. Like, here's all the different things out there outside of the stock market where you can invest in real assets, right? Really? And that's really cool. We love that. I write a bunch of books. I'll give one away for free at the end of this. I write in Forbes. I've got a lot of podcasts. I speak on stages every month or so. So that's part of that education, and I love it. And it's a lot of fun. It's a bit of a give back. I'm so crazy because I'm introducing my investors to every other way you could possibly invest in the alts space. And we're also equipping them with, here's people that'll do asset protection, and here's people that will do tax strategy, and here's, all kinds of stuff, right?
Yeah.
And then on the other side, we sponsor deals. We sponsor deals which align with our values, and we strive to have our investors achieve mastery in the art of passive investing.
Love that. So you're not running like a fund to funds model then. You're not doing like SPVs into different deals. You're sponsoring the deals directly, and then like having the investors in your group like invest directly.
I have in the past. I used to participate in SPVs and multifamily apartments. Yeah. I also did some investing in oil and gas, some energy.
Nice.
Right now we have, it's private credit and commercial real estate, which is a debt fund. That is doing extremely well, because right now you can lend at really high rates. What used to be 6, 7, 8%, it's like 12, 13, 14 for the same asset, because small balance commercial real estate, maybe like 600 to 6 million in sale price. Like, banks are just not paying attention right now. And so that's really cool. And those operators really need that source of relief. They need reliable debt, somebody they trust. Yep. And then there's the other side, which is equity. I mean, those same operators, sometimes they just need out. We buy it. We buy cash buys in our acquisitions fund, which is freaking amazing right now. It's like going through 2009 and 10 in residential real estate, but we're going through right now in commercial. And so you can lend high rates and buy at low prices. And then and those are separate. We originate everything in our debt fund. We buy everything in our acquisitions fund. And then we originate everything in our litigation portfolio as well. So those are all loans to attorneys, similar to our debt fund and a diversified pool.
Yeah. Let's talk a little bit more about that. I think that's a really interesting niche that not a lot of people understand or know about. And I only recently discovered this whole world of litigation finance. So can you just give a broad definition of what litigation finance is? And then we'll kind of get into the nuts and bolts of how you guys work on that.
Yeah. I mean, once you identify, hey, look, here's an industry I really want to get exposure to because it's recession resilient and non-correlated. And that slice of my pie is going to be really strong. You got to figure out how to fill a need in that industry.
Mm-hmm.
And just like in real estate, how there's operators wanting to buy properties and CapEx to improve properties to provide housing to tenants. There's a niche part of the legal industry where there are legal operators who are attorneys working on what they call contingency fee. It's not that they're doing it for free. It's that they're doing the work because they believe in the case and they'll get paid contingent upon success, right? And so in that case, we can lend to these operators who have assets. They have not a building, but have a list of clients or that have proof of harm and medical records. And then they have a certain progress on the case where they're negotiating settlements or there has been a settlement announced. And we can get that valued. Law firm valuation guy, just like we have a appraiser in real estate, can value that docket. Then we can put a lien against it, just like you can in deed of trust, real estate, and you can put a loan to value against it, just like you can in real estate. And then that operator, that legal attorney, right? They can use that cash flow to either those proceeds to acquire more claimants or as operating expenses to get their existing clients across the finish line to provide access to justice for those that otherwise couldn't afford it.
That's super fascinating. So, and then of course, these settlement fees can sometimes be incredibly lucrative, right? And so I'm assuming that there is like a variable fee structure, right? With the operator, like if they is it usually a pretty standard split, or does it just vary based on the case and like the strength of the attorney's like client list / track record, et cetera?
I don't think there's any litigation fund alike. There's not a ton of them out there, first of all, but there's probably of the couple dozen I know of, none of them quite do it the same. And I think it's the same in real estate. It's like putting all of real estate investing in one basket, right? Mm-hmm. And there's a lot of different ways to go about investing in the legal industry. And there's a lot of different ways to go about participating in third-party legal funding. And when you talk about returns and lucrative and risk, it has a lot to do with the continuum that you see in real estate or oil and gas or venture. You can get involved really early in seed funding and venture rounds and huge returns, huge risk though.
Yep.
Or you can be oil and gas wildcatting, or you can be investing like a crazy person in pre-development real estate like I did in 2009 and 10 and lost my ass, right?
Yeah.
But then there are those who have been humbled and we're like, nah, I actually kind of want to wait until maybe we've got proof in the pudding with the market. We've got proof in the pudding of the building, and we're building maybe some additional buildings in an existing market, right? Or I want to invest later in this startup that's no longer a startup because I'm in like round, D or E, right? Before it goes IPO. Or in our case, or your oil and gas drilling, you can drill it next to proven undeveloped sites, right? Next to oil and gas wells, right? In our case, these cases have gone through the legal system. There's been demonstration of harm. They have clients on there that have proof of harm and exposure. And there's a discovery done to demonstrate that the defendant, the big bad Goliath, has done something wrong. And there's been a mass harm, call it a mass tort. Tortum is wrong or injustice in Latin. And in that particular case, if it's gone into the courts and these expert witnesses have been allowed and the discovery's done and they've started negotiating settlements, or there's already been settlements, or there's a settlement grid, like in our Camp Lejeune case, it already says, here's what you're owed. Then we have a pretty clear picture through our partners that value these dockets, what they're worth. And then that allows us to give, to your question about returns, a pretty good return, right? Based on a measured amount of risk prior to the judge gaveling down an award or a settlement being struck.
Yeah.
And we kind of late staged.
Yeah. So are these structured primarily as like equity or debt positions?
It's funny you ask that. So getting into the nuts and bolts can get complex, but
yeah,
it's a little bit of neither in our case, because it's not just purely debt in the sense of we're lending against a property for principal and interest.
Yeah.
In our case, and it's not equity because you can't participate in an equity position in a law firm. They have ethics issues with that. So they can't go to, law firms can't go raise from venture, right? Because they can't have a board of directors mucking with the attorney-client privilege. Like their obligation is to their client. They can't go oftentimes to banks because they can't have somebody go foreclose on their contracts, right? So they have to go to boutique shops. So we actually structured a little differently. Majority of ours are structured as what's called a prepaid forward contract. Why that's cool is it actually means our returns come back as capital gains, long-term capital gains, as opposed to interest income, which is way better than ordinary income, ordinary tax rates. So kind of none, but the answer is it's a little bit of both in the way it looks. Sometimes we have a waterfall on the proceeds. Sometimes we have a split certain districts, but it's a little bit different.
That's, man, this is so fascinating. I love this stuff, man. And I do agree with you that, you know, if you're looking for resiliency, I mean, as long as the United States stays the way it is, like litigation is not going away anytime soon, right? I think we're the most sue happy country in the world, right? Like, I don't think any other country in the world sues as much as we do per capita, right?
It was pretty bad, but the general sense about this is, so just like in our real estate deals where we say we want to provide a cleaner, safer, and improved living experience for our residents, we don't want to be the slumlords of the legal industry. We don't want to be in the frivolous lawsuit space. We don't want to be in the ambulance chaser space, right? So
Right.
We're not an impact fund. We're not an ESG fund. But we do talk about profit and purpose, right? We want to be part of creating actual social change, getting meaningful settlements to the harmed individuals. We're talking $50,000 to $500,000 to these harmed individuals. We just contributed to attorneys who have prevailed in a case against the LA Juvenile Detention Center where they sexually assaulted our children. That's hit home to me. I'm from California, right? And you can look it up right now, billions of dollars in settlements to these harmed individuals which were assaulted. And so that was a big win for the harmed. And our attorneys and our investors also got to participate in those returns because we helped fund going against a big bad life. Same thing with the Camp Lejeune water contamination. 17 years, the DOJ fed contaminated water to our military, civilians, and their families that were at a Marine base where they trained to go to war. Hit home to me because I'm actually a military. I was born in Italy, actually, because my dad was in the military, and actually I have a couple of apartment buildings I own down the road from Camp Lejeune. So I'm a partner in. So that's a lot of other things like infant baby formula and Roundup issues where, Bayer now, Monsanto now Bayer falsified EPA reports, right? And now the people who are the farmers and landscapers are dying horrific deaths. So there's actually sue happy. There's a kind of frivolous lawsuit kind of in any industry. You can be a part of the problem or you can be a part of the solution. And I like to think that in our particular case, we're not necessarily contributing towards a sue happy, country. We're contributing towards accountability for those companies who, have done harm.
I mean, and I appreciate you clearing that up because honestly, like when you do think contingency cases, right? You often think of the ambulance chasers. I mean, that's the first thing that comes to mind, right? It's like Better Call Saul, you know. So it's what's that?
Is that ouch?
Yeah. Well, yeah. That's what comes to mind, right? Like when you think contingency cases. But I think that, you know, that explanation or the way that you just described it, Patrick, like does make a lot of sense to me. There are a lot of people out there that have, you know, faced harm, and you're contributing to the accountability portion of it. So, which I think is awesome. So switching gears a little bit, let's talk about IRAs, because you mentioned that earlier. You mentioned like, hey, like, you know, most Americans are just trained to like, you know, set up an IRA account, whatever, and kind of like push everything into the public markets. But recently, I think that there's been a push and an education, right, or more education in our system that allows people to, or that has enabled individuals with IRA accounts to understand that they can actually use those accounts to invest into alternatives, right? So talk to us a little bit about you know, your experience in like self-directed IRAs and how people can you know, convert their current portfolios into things that they can use to invest into things outside of the stock market.
Yeah, and Trump's taken a big red pen right now to lessen the strangulating control that these, you know, IRA companies have had and these 401k companies have had on investors' wealth, and I think it's a really great thing. So if you have a prior 401k, and I'm not an accountant, I'm not a financial planner, I'm not an attorney, so I can't give accounting, financial, or legal advice. That's not what this is. But I have articles in Forbes I've written on this, so I have some of this peer check stuff. But you have Forbes, Patrick Grimes, IRA, you get it all there. So, but if you have a prior employer's 401k, or you have an IRA that you set up, and you have a custodian, they're not going to tell you that, by the way, you can take this away from me. Why? Yeah. Why wouldn't they tell you that? Right? Because this turns out to be their annuity. Like, you are their annuity. They are making passive income off managing your wealth, whether you win or lose. And they're a dying breed right now. And the market for financial planners has not been growing. And so it's, they're going to do what they can to keep control over it. But they're only allowed by the companies they work for to put those funds into vehicles approved by their companies. And those are vehicles that they get paid for. And so you just think about these guys, they're sales guys looking out for themselves, and trying not to play within the lines and the rules. But the disruption that Danny's talking about is that there are, in fact, self-directed IRAs, both traditional and Roth. There also are variations of 401ks, which are self-directed, EQRPs and solo 401ks. I have a solo 401k, for example, where you can roll some of what was under strangulating control, right? If it's a 401k from a prior employer or an IRA, you can roll some of that into a self-directed variant of that account. That would then allow you to buy a ton of different things outside of the stock market, right? You can, there are certain qualities and ways you can invest in gold. There are certain ways you can invest compliantly into Bitcoin. There are certain ways you can invest in real estate, allocate into real estate deals, or litigation finance, right? Or healthcare investments, things that there's a bunch of ways that you can go about it. And we work with dozens of these custodians, and about a third to a quarter, I think, of our investments has been traditionally from individuals who are self-directing part of their retirement accounts into or allocating them into our investments. So it's a tremendous way for people to take where they've socked most of their wealth away and put it at the whim of the sentiment-driven stock market to start building a more secure future into alternatives.
It's a hotel deal that I'm sponsoring right now, and was on a call with an investor, and we were just kind of going through her options and everything. And we talked about her portfolio, and I asked her, I said, well, hey, did you know that you could actually like invest part of your retirement portfolio, like part of your IRAs into into this deal. And she's like, oh no, I didn't know that. And so I kind of like explained the entire process to her. And based on her, like our minimums versus what she had, like she was fine, right, to invest this deal. And so she says, she's like, oh, pulling this money out of the stock market. Oh, it's too risky. Yeah. She's like, it's too risky. So I can't pull it out of the stock market. It's too risky. And I was like,
right.
So what's riskier? Having a concentrated amount of your net worth into completely correlated, asset class, or investing a very small sliver of that into a real estate deal? What's more risky? Having all your eggs in one basket, or starting to spread some eggs around? They don't get
Preaching the fire here, Danny.
Yeah, man, I know. They just don't get it, man. So what would you say to someone like that? I mean, what's the message? Because obviously you've had a lot of these conversations.
Well, I can't give financial advice. So I gotta first say that. But me as a engineer meandering my way, have seen my 401k account get pummeled. Yeah. And I've seen real estate take a dive. I've lost it all. And I've seen what happens when I get way excited and over-indexed in any one type of investment twice. And why would I continue to do that? There's the de facto way that, our employers first say, go use this custodian, put it all in the 401k, and that's good enough. And then there's what some parents and grandparents have said, here's our family financial planner, that go use that and they'll take care of it. The challenge is that there's just not the financial IQ in America. There's not the education platform out there to explain to people how to evaluate risk and how to allocate and balance things out so that you don't end up holding the bag if your one asset takes a swing, right? And on the down, and you end up needing to draw on it when your 401k is super low. And if you didn't have anything else you could invest in, you don't have any other income, any other assets that are still coming back to you, you could be in a really bad position, especially if that happens around retirement. So I think what happens is that people need to start really transforming themselves. And what I say is that you really just need to take one passive step a day. Take 10, 15, 20 minutes. I run for 45 minutes, an hour every morning, and I listen to educational audiobooks, webinars, TED Talks. I listen to things about investing, things that I want to learn about. So I get all these concepts passively, whether you're driving in a car, or you're doing laundry, or whatever it is. And then do one active step a week, or at least every 2 weeks, where you're physically getting around other people that are knowing and being like these other ways. And that's necessary because we're tribal, nomadic people, right? Nobody wants to go into the jungle by themselves or out of the desert. And if you're like me, none of my family were in alts. And not anybody I knew was in alts. I had to find my own way. Once you start getting involved, you start hearing the patterns, starting to understand the way people think differently and talk differently about balanced portfolios and alternative allocations. And then you start surrounding yourself with those people that are doing it. You'll begin to get transformed to somebody who has a better perspective. And then you realize, man, I've been living in fear. Yeah. I've been living in fear because the news constantly is talking about this looming recession and inflation. And I've been living in fear. But every time I've taken that step to allocate a slice of my pie into a different non-correlated alt, I feel a little bit better. I feel a little bit better about my outlook and my future. And I am less worried about the stock market. I'm less worried about that next recession because I've got allocations in oil and gas. I've got some in gold. I've got some in real estate. I got some in private credit. I've got some in legal, right? All these things that they don't care.
What would you say your overall outlook is right now? Or how has your outlook changed over the last 15 years or so since you kind of came out of 2010 on prioritizing investments that cash flow versus investments that are more appreciation / equity plays?
Well, I was a machine design, automation, robotics engineer, and I went from being in W-2 to a contractor, and even through COVID, I went and I didn't do much other than COVID assembly test kits. And so I was pulling in pretty significant income throughout all that time. So I was not needing a income generating asset. I believe that it's healthy for the assets to support themselves. If say they're a rental property, for an allocation, but I don't think everything has to have income. I think that if you look at the allocations of the wealthy, you'll see some in stocks, some in bonds. You'll see some in fixed income. For Sliver, like 8 or 9%. You'll see 25% typically in real estate, and you'll see another 26% in different alts. There isn't any one size fits all, and you've got to change and balance. I think later in life, like I'm still at a position where I think I'm leaning towards growth for the majority of my portfolio, but we have that income fund, which the whole purpose of it is steady, eddy cash flow. And I think I told my wife, hey, look, we're going to do this because it's the right thing to do. You're never going to get rich off debt, first position debt, right? Yep. But it's going to be there. It's going to be there if things go rough. If things go south again, we'll have that to draw on.
Yeah, that makes sense. And I think that there's, personally, I've seen a lot more individuals participate in private credit and debt funds over like the last year and a half. And I think part of it too is just like, you think about the risk reward right now, especially with rates where they're at. To your point, like if I could take a preferred equity position, which I guess would constitute, we should be inside of a private credit kind of like offering preferred equity, you'd maybe collecting like a 14 to 16% return. There's a lot of multifamily and like other, there's a lot of commercial real estate deals that aren't clipping that kind of return right now, in a common equity position. So we're in an interesting time right now, Patrick, where I think the risk reward heavily favors private credit, private debt. And I don't know that the rates are going to come down significantly enough over the next couple of years for that to go away. So I do think that like this is something that could be a part of like a longer term investment strategy, kind of given where we're at right now with the rates, I
agree.
Yeah.
But I'm not a big preferred equity fan. Because that's still equity. It's just preferred position equity. I'm more of, we're in first position senior secured and at low leverage. So like below 60% loan to value. Yeah. The preferred equity might take, that 60 to 70 or 65 to 75 and then common equity above that. But what we've seen before in past downturns just through COVID is fluctuations 10, 15, 30% on average throughout this country. That puts a lot of strain on the entire equity stack. I'm not as big a fan on the preferred equity. Those are clipping strong returns, but we are actually clipping pretty strong returns in small balance commercial real estate without having to go the equity route with being the lien holder, right? Yeah. With the secured collateral with 40% cushion from market volatility, which is pretty strong. Yeah. And that's better to me because I've seen it fall before, way more. I've seen it fall before, not commercial real estate. We just saw it fluctuate in those just in the last couple of years. So I feel a little better there. There is a lot of really interesting, they're kind of calling themselves debt funds, but they're actually equity and pref equity funds. But there is a lot of really interesting plays out there for that. Just not my favorite. I usually go for either the secured or the equity, not really a blend so much.
Makes sense. It makes sense. Definitely makes sense to me. You've got a book and you kind of foreshadowed earlier in the episode. So I wanted to kind of take some time here to give you an opportunity to tell the audience a little bit more about it and how they can find it.
Yeah, well, I'd love it if anybody wanted to have a conversation out there. It's one of the things I love to do in this world. I always keep time on our website. We have a passiveinvestingmastery.com. Passiveinvestingmastery.com as a Calendly where you can set up a time. And we have about 50 alt assets we've highlighted through our alternative investing mastery series, which you can register for and start joining on a almost weekly basis now. Be delighted to chat with you and see if we get you pointed in the right direction, whether it's with us or somebody else. We probably have it. And part of that journey that I've been on, which has been kind of ups and downs, and I'm by far don't have a perfect track record. I mean, that means if you skinned your knee, that means you've been playing the game, right? You've learned a lot. And so I've taken some of those lessons and been vulnerable and transparent, put it into a chapter in a book along with some other guys. It's actually called Lessons from Thought Leaders. And if you go to our website, passiveinvestingmastery.com/book, you can put, as long as you put the name of the podcast in there, you can download the ebook, or you can register to download the ebook and get the whole book, which I had such a good time, right, with this group of people. I mean, Phil Collin, lead guitarist Def Leppard, did a chapter. I just have this guy in here. There's a Navy SEAL did a chapter. Brian Tracy is in here. Kevin Eastman, Tom Ziegler, Dennis Waitley, just so many cool people. Really fun book. We all tell our stories, and I tell my, the ups and downs and journey through high tech and losing it all, and single family apartments, energy, non-correlated, real estate, private credit, legal, talk about all that stuff. Getting married in China and stuff. If it inspires somebody along their journey, it's enough for me. So just go to passiveinvestingmastery.com/book. Make sure you put the name of this podcast in or else we won't send anything to you. We'll get a signed copy shipped out to you for free. Set up a call though. Let's have a conversation. Register for our Alternative Investing Mastery series. They're on that site. And if you're at home like, hey, maybe this makes sense. Maybe I should add a sliver, right, to my pie chart. Investwithpatrick.com. My director of marketing said, look, people keep asking you what your favorite alternatives are. You should just put something together. So I put Patrick's favorite non-correlated alternatives together, put that together, and investwithpatrick.com. You can go there and it's a download, and you can download it. And it's just like a list. But then if you want to read about any particular one, you can go further deep. And I ramble on some amount for each of them. So happy to, contribute to your life in any of these ways. And hopefully we get to have a conversation at one point.
It's awesome. Thanks, Patrick. And the link to that will be in the show notes. The link to his book and his website will be in the show notes down below. Before we go, Patrick, a couple of things here as we're wrapping up. You've talked about underwriting stress tests to safeguard investments. What would you say are some of your favorite stress tests to deploy, like a quick and dirty underwriting? Obviously, if you're doing a really, really thorough underwriting, but what are some quick stress tests that somebody could use when looking at a deal that would give them a good idea as to whether or not it's a safe investment or safer investment?
That's, it's hard for me to answer a question like that. After I lost everything back in 2009 and 10, and I got a master's in MBA, and I was like, okay, I have money to investing in, where am I going to go? And then the breadcrumbs led me back to Alts, led me back to real estate. I went to the Fred, it's called Fred's website, and where you can literally plot out like different kinds of industries and different specific markets, and see over a long period of time, overlapping all the downturns and recessions that we've had in different markets. You can see how they've all performed. And we actually show them on our slide deck, all the industries: gold, oil and gas, the stock market, real estate.